What is the Federal Reserve and how does it influence the U.S. economy? You may hear about the Federal Reserve when inflation rises, interest rates change, financial markets move, or the economy begins to weaken. But what exactly is the Federal Reserve and why can its decisions affect so many parts of the economy? The Federal Reserve, often called the Fed, is the central bank of the United States. It was created in 1913 after the U.S. had experienced repeated periods of financial instability and banking crises. The goal was to create a more organized approach to central banking that could help support greater stability in the nation's banking and financial sectors. The Federal Reserve is a system made up of the Board of Governors in Washington, D.C., and 12 regional Federal Reserve banks located throughout the country. Together, they carry out responsibilities that can influence banks, financial markets, businesses, consumers, and the broader U.S. economy. One of the Fed's most important responsibilities is monetary policy. Monetary policy refers to actions taken by a central bank to influence financial conditions in the economy. In the U.S., monetary policy is guided by two major goals established by Congress: maximum employment and stable prices. These goals are often called the Fed's dual mandate. Maximum employment refers to an economy where employment is as strong as it can sustainably be, while recognizing that some unemployment will always exist. Stable prices refer to keeping inflation low and predictable so that the overall purchasing power of money remains relatively stable over time. These two goals are closely connected to the earlier concepts we have discussed, including inflation, purchasing power, and economic growth. Interest rates are another important part of how the Fed can influence the economy. While the Fed does not set every interest rate in the United States, its monetary policy decisions can influence financial conditions throughout the economy, eventually affecting the rates people encounter when borrowing money, the interest they can earn on their savings, the cost of financing a business, and conditions in the housing and financial markets. Imagine that financial conditions become tighter and borrowing becomes more expensive. Some households may delay major purchases, while businesses may postpone expansion or become more selective about new investments. Demand across parts of the economy may begin to cool, and over time those changes can influence economic growth, employment, and inflation. Now imagine financial conditions becoming easier and borrowing becoming less expensive. The process can move in the other direction as households and businesses become more willing to borrow, spend, or invest. This ability to influence economic activity is one reason why the Federal Reserve receives so much attention. The Federal Reserve also has important responsibilities beyond monetary policy. It supervises and regulates certain financial institutions, provides financial services that help banks transfer money and settle payments, and works to promote the stability of the broader financial system. Together, these responsibilities give the Federal Reserve an important role in the U.S. economy. While the Fed can have a powerful influence on the economy, it does not directly control prices, wages, every interest rate, or the stock market. It can influence the conditions surrounding these things, but the final outcomes are shaped by consumers, businesses, banks, investors, governments, and global markets. Now that we have learned what the Federal Reserve is and how its decisions influence financial conditions throughout the economy, we can move on to one of the most important parts of that influence: interest rates. In our next video, we will look more closely at what interest rates actually are, why they rise and fall, and how they affect borrowers, savers, businesses, investors, and the broader economy. If you found this video helpful, please like, share, and subscribe to Life and Money for more practical, beginner-friendly lessons about money, investing, and the economy. Thank you for watching.